Let me start with something I've seen more times than I can count. A couple sits across from me, usually in their early 60s. They've done what they were told. They worked hard. They saved. They invested. On paper, everything looks fine. And then one of them asks a question that always tells me what's really going on underneath. What happens if the market crashes right after we retire? That question isn't about numbers. It's about fear. It's about the quiet realization that when paychecks stop, mistakes suddenly matter more. You don't get unlimited do-overs anymore. Here's the uncomfortable truth most people don't realize until it's too late. Retirement doesn't usually fail because someone didn't save enough. It fails because all their money is exposed to the wrong risk at the wrong time. Markets go down. That's not a theory. It's history. If you're retired long enough, and most people will be, you will live through multiple downturns. The real danger isn't the downturn itself. The danger is being forced to sell investments during a downturn just to pay your bills. That's how a solid nest egg quietly erodes. This is where the retirement bucket strategy comes in, not as some clever trick, but as a way of bringing order and discipline to your money when emotions are at their worst. The idea is simple, but the impact is powerful. Instead of treating your entire portfolio as one big pot of money, you divide it based on time. Not based on labels, not based on excitement, based on when you'll actually need the money. When you do this correctly, you're no longer reacting to the market. You're giving each dollar a job, a timeline, and a level of risk it can responsibly handle. I didn't invent this idea. Versions of it have been discussed for decades in retirement planning literature, from classic asset-liability matching concepts to modern discussions around sequence of returns risk. What I've learned over the years, though, is that people don't need more theory. They need a framework they can live with during stressful moments. So let's walk through this the way I explain it to clients. Calmly, practically, without pretending the future is predictable.
The retirement bucket strategy works by separating your money into 3 distinct buckets, each tied to a different time horizon and purpose. The first bucket is your short-term bucket. This is money you expect to use within the next 1 to 4 years.
The third bucket is your long-term growth bucket. This is money you don't expect to touch for at least 7 to 10 years, often longer. Because time is on your side, this bucket can be invested more aggressively in growth-oriented assets. Market volatility matters less here because recovery time exists. Historically, markets have always recovered given enough time. That doesn't make downturns comfortable, but it does make them survivable if you're not forced to sell. Now here's where this strategy really earns its value. One of the biggest threats to retirement success is something called sequence of returns risk. It sounds technical, but the idea is simple. Poor market returns early in retirement can do far more damage than poor returns later, even if average returns end up being similar. Research has shown that 2 retirees with identical portfolios and identical withdrawal rates can have completely different outcomes depending on when negative returns occur. Early losses, combined with withdrawals, permanently shrink the portfolio's ability to recover. The bucket strategy helps reduce this risk by design. When markets fall, you're not scrambling to sell stocks at depressed prices. You're drawing from your short-term bucket, which was built for exactly this purpose. Meanwhile, your medium and long-term buckets are given time to recover. In some cases, income from bonds and dividends in the medium bucket can even be used to refill the short-term bucket, reducing pressure further. And when markets eventually rebound, as they historically have, you can rebalance by moving gains from the long-term bucket back into safer buckets. This isn't about predicting the market. It's about controlling your behavior when the market becomes unpredictable.
What many people don't realize is that this strategy isn't just for those already retired. It works just as well during your working years. Before retirement, the first bucket often functions as your emergency fund and short-term savings. This prevents you from derailing long-term investments when life happens. Job loss, medical expenses, unexpected repairs, these things are inevitable. Having a dedicated pool for them protects everything else. The second bucket can be used for medium-term goals, a home down payment, education expenses, or planned life transitions. The key is aligning the investment risk with the timeline. Money needed in 5 years shouldn't be riding out 10-year market cycles. The third bucket is where retirement investing truly happens. This is where consistent contributions, disciplined investing, and patience matter most. Buying through downturns, reinvesting dividends, And allowing compounding to do its work over decades is how wealth is quietly built.
As retirement approaches, the strategy evolves. Assets are gradually shifted. Profits are taken during strong markets. Risk is reduced intentionally, not reactively. The goal isn't maximizing returns at all costs. It's maximizing the probability that your money lasts as long as you do. Transferring money between buckets becomes part of regular maintenance. Periodic reviews help ensure upcoming needs are covered. Income from the medium bucket can support short-term needs. Strong market periods create opportunities to rebalance without panic.
What this system provides, more than anything, is peace of mind. You're no longer asking the market to cooperate at the exact moment you need money. You've already planned for the moments when it won't. There's no strategy that eliminates risk entirely. Retirement will always involve uncertainty. But retiring without a structure is far riskier than retiring with one. The bucket strategy doesn't promise perfect outcomes. What it offers is resilience. It helps you stay invested when it matters and stay liquid when you need to. And in retirement, that balance often makes all the difference.